The holy grail for real estate investing has been, for the last couple of years, finding a cash flowing rental property that meets the 1% rule. And I recently found a deal that meets the 1% rule, but I'm not going to buy it. And in this video, I'm going to show you why. Hey everyone, it's Dave Meyer from BiggerPockets, and today I'm going to explain to you how I think about the balance between cash flow and appreciation in rental property investing. For many years, the dogma has been that you have to find the best cash flowing deal, and you want to find one that meets the 1% rule. If you've never heard of this rule, it's that your rent to price ratio, which is 1 month of rent divided by the purchase price of the property, should equal at least 1%, or be better than that. So if you buy a property for $400,000, you would need rent of $4,000 per month to meet the 1% rule. That's all well and good, but the problem is over the last couple of years, as housing prices have gone up, it's been increasingly difficult to find 1% rule deals, and it's sort of become a needle in a haystack kind of thing. But I have never believed that the 1% rule should be followed under all circumstances. And even though I found a solid property that meets the 1% rule, I'm going to share with you why I'm not going to buy it. So here's the deal. I am looking at a fourplex in the Midwest. It's in a really strong market with good fundamentals. It's an off-market deal that my agent sent me. I think one of his friends or brokers was trying to move this property. And it has pretty solid rents right now. 2 of the units are rented at $1,300 per month each, and 2 of the units are vacant. So if you extrapolate that out, that's $5,200 a month in rent. And I could pick this up at $505. I had a verbally accepted offer from the seller. So that means I would be above the 1% rule with rents as they are today. I actually emailed my property manager with this deal, sending him the information, asking what he thought the rents could get to if I were to invest some additional money into the deal to renovate the properties. And he said that would get us somewhere between $1,600 and $1,800 a month. Now, I'm a pretty conservative investor by nature, and so I started underwriting this deal saying, what if I put $40,000 into this property? So I was going to put $10,000 into each unit and get those rents up to $1,600 a month for a total of $6,400 of rent a month. If I could get this, if I could just get it up to $1,600 a month, which again was the low side of what my property manager estimated, then we're talking about serious money. So that would get me $15,000 a year in cash flow, or an 8.4% cash on cash return. Those are numbers that you do not see in today's day and age. This got me super excited. I was all in. I wrote an offer and had a verbal acceptance on this deal because I was so excited. How could you turn it down? But at this point in doing your due diligence on any deal analysis, you need to start looking for red flags and seeing where some things could go wrong. And as I did this, a couple of things came up. Number one was the age of this property. So it's a good property in a good location in a good market, but it was built in 1910. And if you know anything about real estate, that spells a little bit of trouble, right? You're going to have a lot of capital expenditures. You're probably going to have a lot of repairs, especially if previous owners haven't spent or invested back into the property to bring your systems up to current needs. So that was number one. I was worried about the age of the property. The second one is that it's on a busy road, and that can work sometimes, but to me, I think it limits the appreciation upside. It also didn't have off-street parking, which is going to limit what I can charge per rent. So those two things made me think, instead of just going out, signing this offer right now, I'm actually going to fly to the market and go look at this property myself and see if it's actually a big deal that it's on a busy street. And I also wanted to look at the house itself and see what repairs were really necessary. So once I got to the property, that's where I started to see some things that concerned me. And the thing that really limited the upside on this property was that the second bedroom was just very, very small. And I know from studying this market that in order to get that $1,600, $1,700, $1,800 I need to make this deal pencil, that you need 2 true bedrooms. I actually own a property just down the street from this one that has 1 big bedroom, 1 small bedroom, and I rent it out for about $1,350. And that works for that deal, but this is a much more expensive property, and it wasn't going to work for this one. So all of a sudden now I'm underwriting this maybe more at $1,400 or $1,500 a month. Still could be good enough if there are other upsides like appreciation potential or some zoning upside or any of the other things I look for when looking for long-term value of a deal. But unfortunately, those things just didn't really materialize. I looked at a lot of the systems in the house and they were just very old. I started to get worried, thinking that there was going to be a bunch of headaches. First and foremost, I saw some cracking in the floors, which makes me wonder about the foundation and if there's been some settling that's going to cause all sorts of nightmares. There was some knob and tube electrical, which is super old and a pain in the butt to fix. And so that made me realize that my expenses were going to be relatively high. And given that I wasn't going to generate the rent I originally thought, that started to worry me. The third thing was that just seeing this place on a busy road made me realize that, unfortunately, it just wasn't going to have the appreciation upside that I would be looking for in a deal like this. So actually, check out this framework. This is sort of how I think about buying deals in real estate. On one spectrum, one axis, you have cash flow, and the other one, you have appreciation upside. And I'm personally not super dogmatic about this. I don't necessarily need there to be a ton of cash flow or a ton of appreciation. I'm just looking at the combination of the two and hoping that there's enough of both together to outperform the stock market and other things that I can do with my money. So if you look at this here, you could see that there's sort of these four zones on my chart. Top, middle is where you want to be, high cash flow, high appreciation. The right side is high appreciation and lower cash flow. I would take that sometimes. Low appreciation and low cash flow is definitely where you want to avoid, but I'm also comfortable in the left side with lower appreciation and high cash flow. I would generally define my buy box as this general area. As you can see, I drew this. It's not super precise, but I want my properties to fall into this zone. Unfortunately, after going to the property and charting this out, this red dot is about where I expect this deal to fall. So this deal should have 5, 6, maybe 7% cash on cash return, which is really good in this market. Normally that would get me excited if there was this appreciation upside. But that appreciation upside, I thought it was going to be really expensive and it might be a long slog until you get there. And with low appreciation, I would need that cash on cash return to be 9%, 10%, 11%. And ultimately, that's why I passed on this deal. But the good news is, and the reason I wanted to share this with all of you is, number one, there are good deals out there. You can absolutely go and find 1% rule deals. I've done 2 other deals in this market that met the 1% rule, had the enough upside for me to actually go buy them. And I found both of those deals on market. This one is off the market, but the 2 that I've actually bought were on market. So I wanted to just show you that this is still possible. But at the same time, don't be so strict about the 1% rule. There are tons of good deals that don't meet the 1% rule. And as I just showed you, there are 1% rule deals that I still am not going to buy. As an investor, what I recommend for most people to do is think about long-term upside. You want to find deals, believe me, find deals that are good assets in good markets that are at least going to break even in the short term. But then you need to think long term. Real estate is a long-term game. And so you need to identify that any deal you do has at least 2 or 3 different potential upsides, whether that's value add, rent growth, zoning upside, path of progress, any of those things will do, but you need to have those kickers to turn any deal that you find in today's day and age into a home run. Hopefully this analysis helps you find your next great deal. If you have any questions, please let me know in the comments below. For BiggerPockets, I'm Dave Meyer. Thanks for watching.